We've got Dipan Mehta joining in on the show. Dipan, hi, good morning. Good to have you on the show as always. High quality, Dipan, for Bajaj Finance, but slower growth than anticipated for a stock which has already moved up so much in the last 2 months or so. What is your take on Bajaj Finance now?
Good morning, and thank you for having me on your show. Yes, disappointed. Every time we expect that the pre-provisioning profit is fine, but the actual NPA provision rising by 70 odd percent or 78%, if I'm not mistaken, that really has a big dent on the profitability. And every quarter, I feel that it will flatten out and grow in line, and the NPA provision will increase in line with the pre-provisioning profit, but that's not happened for several quarters, and I don't know whether it will happen in future as well. Seems to be well priced at this point of time, unless we have some major improvement on the NPA provisioning side. I would say the stock is pretty much well priced. Having said that, it's a company which we and our clients are invested in, so we have a positive bias, yet we are a bit disappointed with the numbers which have come through.
The AUM growth number is impressive enough to take care of all the concerns on the NPA front. They are growing at 24-25%, which is almost double the credit growth rate on such a large base.
Yeah, that's right, but as shareholders, we're interested in the EPS, and the EPS keeps getting dented by all these provisions. And end of the day, the growth rates, when I bought the stock, it was 40-50%, has now effectively come down to about 14-15%, I would say on a longer term basis, maybe 16% or so, considering that their NPA provisioning is growing much faster than the pre-provisioning profits. And look, the stock is not cheap. It trades at 34-35 times trailing 12 months earnings per share. So from that point of view, it is well priced. See, it's not exactly cheap. And also one should keep in mind that as the base keeps on growing, even the growth in the AUM will get more and more challenging 2-3 years down the line, or even 2-3 quarters down the line.
How should one look at IndusInd Bank? Dipan Mehta. I'm
Avoid,
speechless.
what can one say? It's an avoid at this point of time. And uncertainties keep on rolling out for IndusInd Bank, which is quite disappointing. Again, a company in which we are invested in. But this is the problem of investing in banks and financials, that at any point of time, you could have such major issue like NPA spike, or for that matter, the derivatives losses which they have got. And this is not new for IndusInd Bank. This has happened several times in the past. Even the previous CEO, Mr. Sopti, he also kind of, I would not, he also disappointed towards the end the way the NPA spiked around the time the ILFS crisis took place. So it will recover from this thing. But the question you have to ask is that why every now and then, every few years, the bank gets into a mess like this? Is there something intrinsically wrong with the risk management systems? And no doubt the stock is extremely cheap, but I think investors shouldn't get drawn by the fact that it is so attractively priced. There could be many challenges going ahead. Most importantly, I feel that they will considerably slow down their overall growth in business, and that may have a little bit longer term negative effect on the profitability of the company.
But what's next now for IndusInd Bank? I'm spending a time here to understand that, look, it's a derivative loss, Dipan. Derivative losses have happened to European banks also. Best of the European banks in the time of crisis, they've reported derivative losses. So it's more like a P&L hit. The management now changes. RBI will have to nominate, they'll have to come up with a new nomination, a new committee which has to be approved by RBI. So who knows, Dipan, as long as the franchise is not, as long as there is no run on the bank and there are no large NPAs and there is no threat to the franchise value, who knows, this derivative loss could be absorbed in a couple of quarters.
It's a nice argument, okay? And I have, played this argument out in my mind also in previous such situations. But I just want to add an element to this thing, that whenever a bank or an NBFC goes to such a massive hit, could be derivatives, could be NPA spiking, immediately it becomes extremely conservative. And what happens is that the growth in the loan book will kind of flatten out or even decline. Net interest income will flatten out or decline. Operating profit costs keep on rising. And eventually, I think they will look at their existing loans also far more closely with more scrutiny, see if there are any other losses which they have to still provide for. And the entire kind of, confidence and the morale and all that takes a hit. And mind you, Nikunj, banking is an extremely competitive industry. Make no mistake about that, it's a red ocean. And in such a situation, if you don't have, aggressive management, then you're going to certainly lose a lot of market share. And that's what's going to happen with IndusInd Bank. And I've learned it the very hard way that just because a stock is cheap, it is a good buy. It doesn't work like that. Who knows? I think that over the next 12 to 24 months, you may get better returns in HDFC, Axis, ICICI, Kotak, rather than IndusInd Bank. And these companies are far more expensive. And if you really want to buy cheap stocks, then look at the PSU banks. I think what numbers have come through from UCO, Punjab and Sindh, Bank of Maharashtra, even IDBI Bank. I think very impressive set of numbers and very great control over their NPAs. And now they're looking at increasing their loan book as well. So I would give IndusInd a pass. As existing shareholders, we remain invested because at these levels there's no point selling it off. But from a fresh investment perspective, however tempting the stock may look, it's better to avoid.
Fundamentally, you cannot justify this move, but technically, if you are not in the market, then you are missing on perhaps the best part of the gains for the year.
Yeah, as usual, difficult question to answer. There's no doubt that it has been so far a patchy earnings season. But look, end of the day, once we are over the hump as far as Trump tariffs are concerned, we should expect the economy and corporate profits to do much better. And let's not forget that we have major tax cuts coming in from this month onwards salaries, as also the fact that interest rate cuts done by the RBI should give a decent boost to industrial activity and overall consumer lending, and also the prediction of a good monsoon. So we are going into the next few seasons with a lot more, I would say, tailwind. And once we have this major issue around Trump tariffs over and done with, I think the earnings also should start to look up, and stock markets are an early indicator. And most importantly, Nikunj, look at the FI numbers. I mean, I'm really surprised that they have come in so strongly. And if you see, go more granular, I think they're going more and more into mid-cap stocks and not into the large cap index stocks. So, I know that we all feel stocks are expensive. Where are the earnings? But, end of the day, liquidity is king. And if money is coming into mid-cap stocks through FI money or even domestic money, then that's certainly going to take the P multiples higher. But I do feel that unlike the other phases of the bull markets which we have seen, this phase of the bull market, I think, will be very selective as well. And it will really test the kind of stock picking skills of the fund managers and professional investors.
Yeah, and this year it's going to be tough to even do that. But Dipan, great to have you on the show. Thank you so much for your time as always.
If you like this video, then like, share and subscribe to ET Now.